All right, what's going on, everybody? It is 8:30 Eastern, 7:30 Central Time, and we are going to get this party started. We are going to be doing the low and no money down real estate investing webinar. Thank you all for joining me. I know a lot of you guys are taking some precious, valuable time out of your busy schedules to be here. Some of you guys had to put the kids to bed early and do all kinds of different things, but hopefully tonight you guys are going to get a ton of value out of this webinar. And I'm super excited because I've done all different kinds of real estate investing in my career. And I think this is hands down the best way to build long-term wealth through real estate. And really in any investment vehicle that I found so far, this is going to be an unmatched investment strategy. And I know for a lot of you that I've talked to prior to the webinar, I know there's a lot of scary things that maybe you've researched and heard about related to real estate investing. And hopefully tonight, we're going to give you guys some confidence and some energy and some excitement to go out and start taking some massive action using this strategy if that is your goal. So let's get into it, guys. If you can hear me, maybe just throw something up in the chat box and let me know that you're good. So if you want to chat, it should be at the bottom. There's a little chat box there. Somebody just raised their hand. So hoping that means that you can hear me. Beautiful. Thank you guys all so much. Appreciate that. Excellent. All right. So let's get into it, guys. First and foremost, the boring part I have to talk about here. We have a little disclaimer here. I am not an attorney. I am not an accountant, financial advisor. Anytime you make investments, they have risks, and you should consult your professional team prior to making an investment in real estate or other investments. This webinar is for educational and entertainment purposes only. There we go. All right. So I had to get that boring stuff out of the way. I want to give you guys a little background on me, so you guys know a little bit about me. For those of you who don't know me, I'm not going to spend a ton of time on this because this is really not about me tonight. This is about you guys and trying to help you all. But just so you know a little bit about who I am, if you don't know me, and why I am here. So to get started, my wife, Carrie, she's up here in the corner. She's my best friend, business partner. She has been a huge part of this. So anytime I say I, it's really we, or really a lot of times more so her. I'm just the one that's willing to get on camera and share this stuff with you guys. But she is the brains and all that behind the business. And then we have three littles you'll see here. We've got Kaylee, Leo, and Hayden. And we are just blessed to have them. We homeschool, and we do that so that we can travel and that our kids are not truant and we are not getting thrown in jail for that reason. So we decided to homeschool, and for other reasons, but we want to show them the world. We recently just moved to Florida. So if you're watching this webinar live, we recently just moved here for the winter. So we're snowbirds officially. And we bought our first duplex, switching over our real estate background back in December 30th of 2016. And since that point, actually within about 3 years, we picked up about 115 rental doors. And I don't give you these numbers as a boastful thing or to brag or anything like that, because some of you might be like, oh, that's it. Others of you are like, dang, that's a lot. Some of you are like, yeah, that's kind of what I expected. So I'm not giving you those numbers for any other reason than just to give you some context on the information I'm going to share with you guys tonight. And all of those 115 doors, we have used this exact same strategy I'm going to share with you guys. And what's been really cool, and again, this is not a boastful number, but I had to recently fill out some information for our bank. And the estimated market value of these properties is right around $6.5 million using this strategy. So whether your goal is one door or 1,000 doors or somewhere in between, you can use this strategy and build some really, really massive wealth over time. Now, that doesn't mean that we owe $0 on this 6.5 million, that we have some debt on this stuff. But what's really cool, we'll show you guys some examples of how this number can really grow and make a huge impact on long-term wealth. So that's a little bit about me. Why buy and hold real estate investing as an investment strategy? I mean, there's so many different investment strategies out there, whether you're a stock market, bonds, all kinds of different things. And then even in real estate, oh my gosh, if you're like a visionary like me, I get shiny object syndrome. And I mean, if you guys have ever heard of Bigger Pockets, you listen to one of their podcasts. Listen to one time. I get done with that podcast. I'm buying a mobile home park. I'm going to Carrie. We're doing mobile home parks. I listen to the next podcast, and we're building a brand new development now. No, forget the mobile home parks. Those are garbage. We're building a brand new development, and every single time there's so many different things you can do in real estate. There's so many different exit strategies. But I want to share with you guys a little bit about why I think buy and hold long-term real estate in general, before we even talk about this low and no money down strategy, why I think just buy and hold in general is such an awesome opportunity for long-term wealth building. So here's a quick example. And what I'm showing you guys here is the power of leverage. And so what I mean by leverage is right here, you guys will see $100,000. If you walked into, let's just say, your bank and you said, hey, I want to buy 100,000. I want a loan for $100,000 of stocks. They're going to tell you to go pound sand, right? If you said, "Hey, Mr. Banker, I've got 5 properties. They're each worth $100,000. Would you give me a loan for, say, $400,000?" They're heck yeah, we'll give you a loan for that. So you could take that same $100,000 that otherwise you would just go put maybe in a stock market or some other type of investment vehicle, and you can buy $500,000 worth of assets. Now, again, this example is using the traditional model, which we're going to show you how you can even supercharge that and have no money in and have $500,000 of assets, or in our case, 6.5 million or whatever. But it's a huge, powerful vehicle to build wealth without really necessarily needing a ton of money to do so. The other reason, there's tax benefits. Again, I said I'm not an accountant, so talk to your accountant about the tax benefits, but I could just speak from my own personal experience by buying those units that I shared with you guys earlier. Because of some of the current tax laws at the time of this webinar. And again, some of that may change if you're watching this later on, but some of those benefits were significant, and to the point where we had to pay zero in income tax, which is a huge, huge benefit. So again, talk to your accountant about some of those things. Control. I think this is a huge thing. I'll share with you guys a mistake I made. I used to watch an oil stock. It was a highly leveraged, again, we're talking leverage, but it was a highly leveraged oil stock. And if oil went up $1, it went up 3. If it went down $1, it went down 3. My stock did. And so I was watching this thing and I thought, man, I understand this thing completely. And then COVID hit and the price just started tanking. And I was like, oh my gosh, I got to buy up all of the stock that I can possibly buy up, because it's only going to go back up. People are going to have to drive and planes are going to have to go and all that sort of stuff. No control over what happens with the stock, right? And the stock just kept tanking and tanking and tanking to the point of it liquidated. Like I was telling my buddy, we were both investing in it, and I said, hey, don't worry, man. The only way we're going to lose is if this thing goes liquid. Like, just don't sell, because if you sell, then we lose, right? But it'll come back up. Don't worry. And it went liquid and we lost all of our money. So I don't like that aspect of it. Real estate, I can control it, right? I can determine what tenants I'm going to put in my property. I can determine if I'm going to improve the property value by fixing it up a little bit. I can sell the property. I mean, there's so many different things I can do by owning real estate that I can't do in a traditional sense. And I'm comparing it a lot to to the stock market. But it gives you so much more control. Inflation of rents. This is an interesting thing. If you follow the real estate market in the current times that we're in right now, there's a shortage of housing out there across country because the cost of new construction is expensive. It's extremely high. And so what's happening is inventory shrinking, meaning that there's less and less places for people to live, which means rents are going to continue to go up. And historically speaking, rents have always gone up. And even in 2008, in some markets, because people were forced out of their homes as far as the foreclosure thing went in 2008, the rental market in some places actually went up. So people were able to charge more for rent because there was more renters fighting for that available amount of supply. So historically, rents continue to go up. So if you buy something today, you're getting $1,000 a month in rent. Historically speaking, that goes up and up and up every single year. Now, in some cases, maybe not. But if you look at the average over time, it consistently goes up. Using the BRRRR strategy, which is the strategy we're going to talk about tonight, the low and no money down strategy, otherwise known as BRRRR, which is an acronym, and I'll explain that in a minute. The return on investment is unmatched. You cannot beat this. I would encourage you after tonight, if you kind of grasp this concept a little bit, have a financial advisor take a look at this with you and ask them if they have any investments out there that they know of that you can give them $0, and they will give you some money back every single month. They'll laugh in your face, right? That's basically what we're going to talk about tonight. It's an infinite return on investment because you don't have any money into the deal. So any money you get from the property is basically like free money you're creating out of thin air by doing this strategy. Again, it's a little more legwork, which we'll share with you guys today, which is why not everybody does this. process, but the return on investment is you can't beat it. The next reason, debt pay down. So what's interesting is historically speaking, and the next one here, the market appreciates. So what that means is every single year over time, the housing market has consistently appreciated 3 to 5%. 2008, obviously a big dip, but historically speaking, it's gone up 3 to 5%. In fact, we purchased a house a couple of years ago, and the gentleman had a bunch of old newspapers in the basement, and we're like, these are so cool, we want to keep these, and we started flipping through them. And what was interesting, there was an ad in the classifieds from like 1920 or 30 or something like that, and rents were like $25 a month, and there were some houses in there for, I don't even remember, something really, really low and stupid, but historically they go up about 3 to 5% on average. Now, if you're watching this and you're sitting in California, your appreciation may be like 15% in some markets. Other markets in California, if people are dipping out of there, it may be really low. But historically, it's 3 to 5%. So what's interesting is when you get one of these properties and you hold it for the long term, the tenants are paying down that debt. So hopefully you're getting enough in rent to cover your debt and all your expenses, and they're paying that debt down, and the market's appreciating. And so what's happening is you're creating this gap in between what you owe and what's happening, and they're both working opposite of each other. So instead of it just being like, hey, if it was a flat appreciation, you had debt pay down, that would still be really cool, right? Like you would still be getting a big benefit from a tenant paying down your debt. But historically speaking, the market goes up and the property values continue to, or the debt continues to go down. So it creates a big spread. And so I want to show you guys just a quick example of this. So I did a quick little scenario here, and I'm just going to show you guys an example. Let's say it's a $200,000 purchase price of this property. Okay. And we're going to assume on the low end that we have a 3% annual appreciation of this. Okay. So that means we're just going to say we're in a market that's a little bit lower on appreciation, and every year it goes up about 3%. And then we're going to assume that we have a 4% interest rate on our loan. So our debt service that we have to pay, we're on a 30-year mortgage. Okay. And we're at a 4% interest rate. Okay. So I know it's a lot, but this is a pretty typical example right now. If you went out and you purchased a $200,000 property in most markets, that's probably pretty fair. Okay. So here's what this looks like, guys. Here's the equity gained over 30 years. And this is the power of this. So even if you didn't cash flow a dollar above what you have into this, look at the equity of this. This is just one deal. This is just one property that you picked up for $200,000. And we're going to assume we didn't get any debt pay down in that first year. It was just, year one was like an interest only loan or something, right? Now look at this. After 10 years, we've created over $100,000 of equity. So the tenants are paying down that debt and the property is appreciating at 3%. Year 15, we've got, I don't know, I'm not good at math, but right around $170,000 of equity we gained after 15 years. And just look at this, guys. We go over 30 years because of the market appreciating 3% annually. And now obviously after 30 years, that loan's paid off. You've created almost $500,000 that you can turn around and liquidate and sell that property, assuming the market is a good market at that time when you're ready to sell. You can create $500,000 from one deal. Can you do that 2 times? Can you do that 5 times? Can you do that 10 times? We're going to show you tonight, guys, how this system that we used and we've used to build our portfolio is repeatable. And that's the most exciting part. You can make this as big of a number as you want, as long as you're holding it over time. Obviously, you sell it a little earlier, you don't have as much equity, but that's okay. All right. There's still some big gains there. Now, talking to a lot of people over the last couple of years, there's a lot of myths people have, or I would call it objections to why they'd want to get started in real estate. They're interested, but they're not quite sure because they have some kind of fear or something. And so I want to just share some of those. So if you're over there on the other side, you can kind of shake your head along with me if you're paying attention here, if this is you. So this is what I hear a lot, especially right now. There's no good deals in this market. The market is too hot, right? I can tell you guys, there's consistently good deals. I added 150, we added 115 doors in 3 years in the same, very similar market. So it can definitely happen. All right. And we're going to show you guys some ways to source some deals tonight. We don't have time to find a good deal or do a good deal, right? Time is a big factor. I know when we were starting out, we had 3, actually at the time we had only 2 kids. We were running a nonprofit. We were in network marketing. I was working full time. Carrie was homeschooling. I mean, there was just a lot going on. And so time was definitely a big factor for us, but it can be done. And there's some ways to do it. This was a big one. I don't have 20 to 25% to put down for a down payment. That's why a lot of folks, I'm guessing, are on this webinar, right? Or maybe if you do, you can do one deal and then your money's gone, right? And I remember when I started, I was looking at a friend of mine. He had 50 units, and I'm like, I know what he did for a living. And I'm looking at me. I had a property under contract the old school way. I was gonna have to put 25% down, and I'm kind of going, man, how is this guy got like a rich uncle, or what's going on? Because how is he affording all of these down payments for these properties? I don't have the network. This is a big one. Like, I don't know what lenders do I talk to? I don't even know what type of lender should I be talking to? How do I get a contractor? Like, I'm not handy. How do I fix this thing up? We're going to show you guys some ways around some of those things tonight. My family thinks it's too risky. This is a big one. I bet there's probably a couple of you guys out there sitting next to a spouse. You guys just looked at each other, and one of you did one of these and the other one was like, right? Some of you guys out there think this is too risky. One of you is the gas pedal, the other one's the brake. Hopefully both of you are on here tonight, and maybe by the end of this, the brake pedal is going to let up a little bit, and you guys will feel a little more confident moving forward on taking some action towards getting started in real estate. All right, I have bad credit or no credit. That's a big one, right? We're going to show you guys some ways tonight to get around that, okay, so that you can still do this even with bad credit or no credit, okay? And I have analysis paralysis. I know for a fact some of you on this webinar have been researching real estate and listening to those podcasts I referenced earlier for literally years. Like, as long as I've been doing real estate, some of you have been researching real estate, and that's okay, right? Like, it might not have been the right time for you to get started in real estate, but maybe you're here tonight and you just want that confidence to be able to move forward, to get past doing the analysis paralysis and have the confidence to get out there and start making some offers and start getting some deals. Hopefully you're going to get some of that tonight. I'm afraid I'm going to mess it up, man. Real estate, it can be scary. I was scared out of my mind. I remember talking to one of my mentors when I got started, and I had a deal under contract, and I was freaking out before closing because I'm like, oh my gosh, what if my appraisal comes in too low and I still have money into this deal? And I remember that. And I remember him telling me it doesn't really matter as long as you don't have to have 25% into it. If anything less than that, you're winning. And I was, okay, that's cool. But there's a lot of other things that can be scary. But if we do it right, guys, it's not scary at all. The first one's definitely going to be scary no matter what. Even if it's like a rock solid home run deal, you're still going to be scared. But hopefully after tonight, you're going to have a lot more confidence moving forward, knowing that you're on the right track and you're doing all the right things. All right, so goals, guys. Obviously, you are here for a reason. What brought you here? If you have a pen and paper next to you, play along with me here a little bit. I think it's really, really powerful when you start writing things down. What actually brought you to this webinar? You signed up, you went through the whole process, you logged in, you got on this thing, you're taking time away from other things you could be doing to be here. There's something going on, and maybe even subconsciously, you didn't even know why you got on here, but now's the time to reflect on it. What are you hoping to get out of this? What brought you here? There's something missing or lacking that you're hoping to get out of this that brought you here. And moving along those lines, what's your goal for the next 12 months? So if you kind of know the overarching theme, maybe it's, man, I really want to build long-term wealth, or I'm afraid I'm one dumb email away from getting fired, or, hey, the next pandemic that happens, I'm not really sure if I'm going to have an income or not after that. I might be let go. And then what do? I want to build some other income sources. Maybe that's the big overarching goal, right? Now let's break down that overarching goal into what's your goal for the next 12 months. So like, what would be a win for you in the next 12 months? Maybe it's, hey man, I just want to get, 4 doors in the next 12 months that I can do the strategy on. Maybe it's 1 door, right? Whatever that is, write that down. Then let's take it down a little bit further. Let's get to the next quarter here. So what needs to happen in the next quarter? So if we know the goal, maybe the goal is those 4 doors, what do we need to accomplish in the next 90 days in order to start moving closer to those goals? And this is really going to help set the framework as you're watching the rest of this webinar. You're going to be able to pull out little nuggets of information. If you know what the end goal is for you, you're going to be able to understand what you're here to actually look for and hopefully get out of this. And what needs to happen between now and then to make that goal happen? So in the next 12 months, what things need to be in place, or what things need to happen in order for you to achieve that goal in the next 12 months? And then similarly, what needs to happen in the next 90 days for you to start making that happen? So think of those things, guys. That's really going to set the framework for the rest of tonight. Let's dive into it. So I mentioned it, the BRRRR strategy. It's an acronym, low and no money down, the BRRRR strategy. What does this really mean? So it's an acronym. The first thing is buy. This is probably one of the most important pieces of the process in any investment. You've heard probably Warren Buffett say and a bunch of these other savvy guys out there, you make your money when you buy, whether that's real estate or anything else. In our case, what we are looking for in this strategy, guys, specifically, we are looking for properties that are usually distressed. Okay. So, what do I mean by distressed? It might be a property that needs a lot of rehab, right? It might be a situation where a seller's in a spot where they need to liquidate that property relatively quickly, and going through a traditional list it, wait for somebody to get traditional financing, 45 to 60 days, and then hope that the financing goes through. They just can't do that, right? And I get asked this a lot. Why would anybody sell their property, especially in a hot market? Why would they ever sell their property for a discount? And one of the best examples that somebody ever shared with me, and I'll share this with you guys, and maybe this will make sense, but why does anybody ever trade in their car, right? Like their car could be, you could list that thing on Facebook Marketplace and boom, you're going to get full retail value for that thing potentially. But maybe you're in a spot where you want just that ease and convenience. Like you roll up to the dealership and you're like, man, I don't want to mess around with tire kickers, or maybe somebody coming back after me later on because I didn't know the transmission was ready to go. Now they're going to try to sue me or something. I'd rather just wash my hands of it and move on. So there's a million situations, but basically what we're looking for when we buy is we're looking to solve somebody's problem. Okay. So in this case, guys, well, that's what we're looking for. Now, we're not looking like if you see a property, say you have an agent out there, somebody's bringing you a deal, and this thing is already rehabbed, it's already looking great, and the seller's really not that motivated, like they want prices like the most important thing to them. That's probably not our property that we're looking for. Okay. And we'll talk a little bit about why that is in just a little bit. The next step, the R, is for rehab. So as I just mentioned, we're typically looking for distressed properties. Then we're going to go ahead and rehab those. We're going to fix those up and add value to it by rehabbing it. And if you're into multifamily stuff, like say you're already doing some deals and you're in multifamily, you've kind of graduated to that, I would say, rehabbing may not necessarily mean like physically fixing up the property. Rehabbing may mean like getting the property to market rent, right? Because that's improving your net operating income, which affects the value and some of those things. But overall, we're looking to just improve the property. So again, if you're getting something that's already like there's no room to add value to it through fixing it up or improving the operation of that property, it's probably not a good deal for this strategy. All right. The next thing we need to do, as we said, is rent it out. So assuming the property is vacant, we're going to fix it up. Then we're going to re-rent it at full market value. We've done some deals where we've actually like fixed it up while the tenants have been living there and gave them a little discount for doing so. So then we've increased the rents after it's been fixed up accordingly to close to market rent. Sometimes we'll give them a little discount for staying there, but we're going to rent it out. And then we're going to refinance the property. And we're going to talk about why the order of this strategy is so important. And so that's why the acronym is listed the way it is because the order of what we're doing is really, really important in order for you to be able to be into these things with no money down. Okay. So then we're going to refinance it, hopefully pull all of that cash back out of it that we used to buy and rehab it. And then lastly, this is my favorite one, we're going to rinse and repeat. The beautiful part about this strategy, guys, is once you do that first deal and it's addicting because it starts clicking, and then you can just repeat the process over and over and over again, and it becomes relatively simple. So again, there's still risks involved and all that sort of stuff, but rinse and repeat and build that thing as big as you want. All right. So why is the order so important? We just kind of briefly mentioned that on the last one. So here's something, guys. This took me a very long time to really understand. Like literally, I thought they were going to have to draw it in crayon for me because I had to ask one of my mentors like 20 different times in different ways, and I'd bring him different examples, and every time I thought he was just going to like punch me in the face after a little bit because it was probably so frustrating for him. But here's why the order of that is so important. So if you buy the first B and you use a conventional loan, okay, so what is a conventional loan? Like you go to Wells Fargo or, BMO Harris or one of the places, you say, hey, I want a home loan. They're probably going to put you into what's called a conventional loan, usually a fixed rate, 30-year finance, government-backed type of loan. All right. Now, here's how they do those loans. the bank is only going to give you 70 to 80% of the purchase price or the appraised value, whichever is lower. Okay. Let me say that again. They're going to give you 70 to 80% of the purchase price or the appraised value, whichever is lower. So there, if let's say you have a property, it appraises for 150,000, you're picking it up for 100,000, they're going to give you 70 to $80,000 for that property because they're trying to protect the bank as much as possible and be into it for the least amount of risk. Okay. So that's why this order is so important. Okay. If you use a hard money lender, which we're going to talk about what that is, and some of those things, private funds, et cetera, when you refinance after we fix it up and everything is done, the lender is going to use the fixed up and improved appraised value. So the purchase price is now irrelevant. Okay. So now if you've improved the value of the property, they're going to lend off of that new higher value. So again, if we go back to this example, if you go and refinance it, now you fixed it up. Now they lend off of that new appraised value. The purchase price is no longer an issue. Okay. That was always the confusing part. I'm like, well, what if I just got a smoking deal on a property and I, just happened to be in a good spot and somebody brought me a great deal? Banks don't care. Okay. They're going to take whichever one's lower. So this is so important, guys. So again, if you don't get that tonight and that's still like blowing over your head, it's okay. It took me a long time to figure that out, but that's why this order is important. So hopefully by the end, I'm going to show you guys a couple examples of this. And hopefully by the end of this tonight, this is going to make a little more sense of why the order is so important. So here's a scenario, guys. Here's an example. If you were just to buy traditionally, okay, so you got a real estate agent. They're going to bring you around, show you some properties that are listed on the MLS. You're going to go put some offers in. Here's how this is going to look. Okay. Let's use this example. Let's say the purchase price you're getting a deal. It's $100,000. Okay. This ARV, it's another acronym. And what that stands for is after repair value. Okay. And there's different ways to figure that out. Your agent should have a pretty good idea of that, but there's other ways, and we're not going to get into all that tonight. So we're just going to assume that that's what it is. It's after it's all fixed up. The market value of that property is $200,000. Okay. Now we're going to go to this down payment section. That bank, let's just say they only want 20% down, not the 25%. Let's just say it's 20% for tonight. Okay. That means you have to put $20,000 out of your pocket or whatever down on this property. Okay. To be able to purchase it. And let's say this property is one of those properties that needs to be fixed up in order to get that value of the $200,000. Let's just assume you got to put $30,000 into this property. Again, if you're in a market where prices are way higher or way lower, it's all irrelevant. It's just an example here to show you guys the numbers. So here's your loan amount. You got $80,000 loan because you have the $20,000 you put down on the $100,000. Okay. So you got a nice equity spread here, right? You got about $120,000 of equity. And equity, if you're brand new, that means like the amount the property's worth versus what you owe. That's the equity. Okay. So you got about $120,000 of equity there. The cash out of pocket, because you had to put the $20,000 down, and the rehab of $30,000, your cash out of pocket is $50,000 to get this deal. Okay. So that's the old school way. I don't know about a lot of you guys, but when I was starting out, I did not have $50,000 to put into a property. Didn't have it. Okay. So that was a big problem. And I'm sure for a lot of folks out there, especially if you're just starting out, that might be a big issue for you. Okay. Here's the scenario, same property, all right, using the BRRRR strategy, okay, that we talked about, following that order and doing things the right way. Purchase price $100,000, after repair value $200,000, down payment 0%. And here's why: we're going to get a 65% after repair value loan from our hard money lender. And we're going to talk about different lending options, but that's the loan we're going to assume that we're getting here. All right. So the lender is saying, hey, I will give you up to 65% of whatever that thing's going to be worth once it's fixed up. Okay. And so we still got to stick that $30,000 in it to get this amount. So our new loan amount, if you take 65% of 200,000, if I did the math correctly, which no guarantees on that, I should have put that in my disclaimer at the start. But if the math is correct, that should give you a new loan amount of $130,000. Cash out of pocket, $0. All right, let that sink in for a second. $0. Instead of putting $50,000 into a property, you did the same exact property, but you just did it for $0. Your net worth just increased $70,000. That's again your equity there. That goes on your profit, on your personal financial statement. and that shows as a $70,000 gain to your net worth. And your cash on cash return on this property is infinite if it even cash flows $1 a month. And if you don't know what cash on cash return is or any of that kind of stuff, that's okay. Just basically think of it like if you're going to go to that same financial advisor we referenced earlier and you're looking to deploy some capital, you're going to usually expect some type of return. I think the stock market averages around 7% return. Basically the same thing. You put in $100,000, you expect to get 7,000 extra $7,000 back at the end of the year. This, you have an infinite percent return because you have no money into it, right? It's insane, guys. It's crazy. All right. And it's done. Like, we're going to show you guys more about how to do this in a few minutes, but I want to show you guys this example. Hopefully this is starting to make sense on why that order is so important in this process. So buying the deal, guys, again, this is one of the most important parts of real estate investing and about using this strategy. Got to be able to buy the deal. So how are you going to get these deals? Okay. How do you find these deals? Right. There's several different ways to do it. We're not going to get into a ton of depth tonight on specific strategies on how to find your next deal, but there are more in-depth options we can get into later on. All right. One of the first ways I'm going to put on here is called driving for dollars. All right. And basically what you do is you can drive around and you find some ugly houses, some properties that look distressed, some properties that look maybe vacant. Maybe they got a bunch of tall grass. Our house, sometimes we're worried somebody's going to do driving for dollars because we just get too busy and don't take the Christmas lights down until maybe June. So if you see some Christmas lights up in June, that might be an option, or it might just be somebody who's really busy. But those are some good examples, right? And I put a link in here, guys, to this app you guys can go to. So if you just go search dealmachine.com, if you want to sign up for that, I got us a discount code for tonight, and it's B for beginners. So B, the number 4, beginners. And what that'll do is that'll give you 15 deal credits. Okay. So what those are, if you're driving around, you download the app. This app is super cool. And again, I'm not going to get into all the details of how to use this thing tonight, but you drive around and you can like ping the house as you're driving past it if it looks ugly, and then you can just send them a postcard. You can take a picture if you want to be super creepy. You hang out outside their house, you take a picture of the house, it puts that picture on a postcard, sends it to the owner with your information on it, says, hey, if you're interested, basically call me, I'm interested in buying your house. Okay. Super cool. You can get their phone numbers right off there if you just want to text them, whatever the case is. It's a really, really cool app. So you can get 15 free credits if you use that discount code. So go out there, fill that out tonight if you want to use that app. Okay. Another option, personal network. This is a no-brainer, right? Friends, family, let them know you're in real estate. Like, hey, I'm getting into real estate investing. If you know anybody that's got a property that they're looking to sell, I'm really looking for something that needs some love, something that needs to be fixed up a little bit. Okay. Great opportunity. All right. Real estate agents, when we first got started, we had we call it the retail agent. So this was the guy who helped us find our house that we live in. And great guy, love him, awesome dude. Problem was he was not a real estate investor friendly agent. So he started taking us around to real estate investment properties, and it just was not a good fit. You could tell it was not his cup of tea, did not like it. We found another agent from a different brokerage, and the guy loved investments. He owned a few investment properties himself, and he would find us some great deals on the market. Even in hot markets, guys, he was finding us deals. We were putting in secondary offers on things, and he'd end up finding a way to get them. So you can find yourself a really good real estate agent or agents out there that can be an awesome source for finding your deals. Even when people tell you there's no good deals on the market, there are good deals on the market. All right. Real Estate Investor Association, that's good. RIA is the other thing you'll hear people say, other networking events, great opportunities to meet other investors. You might meet some people who are maybe on the back end of their real estate investing career and willing to do some kind of creative deals with you. Great opportunity there. We got a 16-unit apartment just by going to a RIA meeting. Happened to be sitting next to a commercial real estate agent. He had what's called a pocket listing, which means it's not out broadcast on the internet yet. He's just kind of shopping it around to people he knows are buying. He's trying to make as much commission on that thing as he can. And we happened to be there, met him, went and looked at it the next day, and boom, done. Signed purchase agreement. So that happened from going to a RIA meeting. So that can happen for you guys as well. Social media kind of goes along with that personal network a little bit, but it's a free source. Go out there, tell people you're in real estate investing. I'm looking for deals. I know I saw one guy that's on the webinar right now. I was actually just liking his post not too long ago. Man, he's killing it right now. He's just out there every day, taking good pictures, putting it on there, asking people to send him deals. It's awesome. I love it. It's a great source for finding deals. Share sales and foreclosures is another option. I would caution you if you're brand new, or even me. I don't buy anything at share sales and foreclosure auctions because I just don't know enough about how they work. There's some risks involved with it, but there are people that's all they do is find deals off share sales and foreclosure. So that might be something you niche into as your source for finding deals, but make sure you do your homework on those. Landlord association meetings, these can be a great opportunity to find, and again, a landlord who's maybe on the back end of their investing career and they're willing to dump some properties. Maybe they've just been living off the cash flow for a while and they haven't really been maintaining the property. They haven't been putting any of that money back into the property. This could be a great opportunity to pick up some properties from somebody who maybe isn't as emotionally attached to the deal and is willing to just let it go for a pretty good number. That makes sense. So landlord association meetings can be great. A lot of times it's mom and pop landlord owners in there, that those are the people that you want to be talking to. Okay. Auction websites. So kind of going back to the share sale foreclosure thing, auction websites can be an option. We bought a couple properties from there. Again, similarly, just if you're going to go on the auction websites, just make sure that you understand all of the fees and things like that. There was a one deal in particular we bought, and there was an extra like $4,500 of closing costs that it was probably somewhere in the documents, but we didn't research it enough or know enough about it, and that ate up a good chunk of the margin we thought we were going to be able to make on that deal. All right, door knocking. This is kind of like a lost art in the world that we live in today with computers and technology and texting and all these other things, right? Door knocking is basically you pick a neighborhood, you go to that neighborhood, you knock on the door, and you basically just ask that person who comes to the door, hey, are you or anybody in this neighborhood looking to sell their property? I'm looking to pick up a property or two in this neck of the woods. And you never know what you're going to find on that, guys. Again, people are always asking, like, how do I find deals? How do I find deals? And they're doing the same thing everybody else is doing to try to find deals. Door knocking is one of those things that there's an opportunity probably in every single market from whoever's watching this webinar tonight. There's probably an opportunity for you to go do some door knocking and nobody else is doing it. And if they are, it's probably not in that same neighborhood. And so you're going to be able to probably do very, very well in that neighborhood. If you find a rental, boom, knock on the door, ask who the landlord is, get their contact information. All right. So again, another opportunity there. Tired landlords kind of goes along with the landlord association meeting. These are folks who we've gotten so many properties over the years that we've either wholesale or kept for ourselves from tired landlords. It's somebody they just have, they didn't use professional management, mom and pop owner. They've got a terrible tenant in there that's just destroying the property, not paying rent. All the horror stories that maybe some of you guys heard from that family member that said real estate investing's too risky is probably because they heard it from a tired landlord, and that landlord now is selling that property at a discount because they didn't do things properly, right? So that's a great opportunity to source some great deals. All right. And then wholesalers. Wholesalers are a great source of deals, guys. Not all wholesalers are made equal. There are some folks out there who are putting deals out basically at retail value, and whatever the case is, but get on wholesalers buyers lists. All right. We have a wholesaling company. We put deals out all the time to people, and a lot of our best buyers are ones doing this exact same strategy that we're teaching you guys tonight. But they are a great resource. Every market, there should be somebody wholesaling in that market. So find out who they are and get on their buyers list and start paying attention to the deals that they're putting out. All right. So that's some of the sources to find the deals. Okay. Now, some of you guys came here because you had no funds, right? You're like, how do you buy these properties with no money? So I'm going to show you guys, I call it the 5 buckets of money. And there's probably other buckets of money out there that you can have access to. Like I know one, for example, we didn't talk about is like, cash value life insurance. That's not a bucket of money we talk about here, but it's a great option, I feel like, for some folks out there for the right people. But there's 5 really buckets of money that you need to get going. And really one of the main things you want to try to do with some of the more institutional lenders, we'll show you guys, is you want to try to get pre-approved through them. Okay. I see this mistake all the time with investors is they want to get deals and then they start finding deals. Like they're like, oh, I'll never find a deal. That kind of that self-doubt. It's too hard. Da, 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 da. Well, then they start doing a couple things and magically a great deal shows up. And they didn't go get pre-approved through any lenders. They're like, well, I'll find a deal and then I'll find the money. Like that's the old chicken or the egg, right? What do? Do you get the deal first or the money first? My opinion, you got to get the wheels in motion for the money first. Okay. So buying the deal in Burr is number 1, but if you got no money to buy the deal, you're not buying the deal. So you got to go get some money sources set up. So here's the 5 buckets of money that you need to get rocking if you want to do this strategy. And again, the pre-approval, what is the pre-approval? That's basically what you're looking for, is just like, hey, I just need a green light from you as the lender that says I'm good to go, right? And how much could you lend me? And how do your lending terms work, right? You want to understand all that stuff. This is like, I call it the crucial first step in growing a serious business. And you want to treat these pre-approvals with some of these lenders kind of like a job interview, right? Like, think of that, like they have the money, you need the money. You need to impress these folks. And down here, we're talking about what's the unique advantage that you're going to be able to provide to ensure that that lender's loan is safe with you. So some of you are really handy, right? Like maybe you're really good at fixing stuff up and you've got a track record, maybe you're a contractor or something like that. Like that's a huge unique advantage that somebody like me with these soft office hands does not have. All right. And so that might be something that would provide your lender with a little more ease, knowing that you can fix up the properties and you can do it at probably a much better price than what somebody like me could do it for. And again, you want to know what these lenders' requirements are. Each lender typically has different requirements, right? And they're going to have different things that they like to lend on and things like that. So you want to understand what are their requirements to get pre-approved, and then go do those things. All right. So bucket number one, this is one you definitely want to have in your quiver, if we will. This is a hard money lender. Okay. So what is a hard money lender? Maybe you've heard this term, maybe not. Maybe you heard loan shark. Maybe you heard money broker. Like a loan shark's like the guy who's going to come like bust your kneecaps if you don't pay him back. And well, depending on what market you're watching this in, that might be true. But money broker, think of it like they're taking somebody's money who maybe was sitting in a money market account or something like that and getting a low return. And they're saying, hey, I'll take your money and I'll get you a better return. And then they lend it out to you as a real estate investor, and they make a little spread on what they're charging you and what they're giving to their investors on the other side. Okay. And there's different types of them. There's a ton of different types of hard money lenders out there. So again, you got to know what their loan program is and how they lend and what their requirements are. But typically a hard money lender, there's pros and cons, right? Typically they're going to have the highest fees and rates, but when you're brand new, it's like, how do you get lower rates and fees? Well, you get more competitive lenders. Well, how do you get more competitive lenders? Well, they usually want to see a track record of success. Well, how do you get a track record of success if you don't have a deal? This is where a hard money lender can come in. They're going to think of them almost like a partner in the deal. They're going to take a bigger chunk, but it allows you to get started in a lot of cases. Okay. This is typically the quickest way to get funds for a deal if you're already pre-approved. So if you're already pre-approved, they gave you the green light, like they can close a deal sometimes in as little as 24 hours. So, I mean, having these guys pre-approved, ready to rock and roll is so important. Even if you never use them, it's great to have them there as an option. All right. And some of them are going to lend you on the purchase price and the rehab. So I shared that example earlier. One of the hard money lenders, or a couple of hard money lenders in our local market, they will lend 65% of that after repair value. So if you're all into it for 50% of the purchase price, like we shared with you, and you got another 15% that you got to put into the rehab, you're into that thing for no money. And that thing is getting fixed up. So that's important. Other lenders, maybe it's 85% of the entire cost of the program. So you got to have 15% of cash into it. That might be their lending requirements, but it's good to have a bunch of these guys in your back pocket because they may have different purposes. I kind of think of them all like little different chess pieces, and you're going to use them for different purposes. All right. In a lot of cases, these hard money lenders, the relationship is important. All right. Even some of the national lenders, like there's some bigger national lenders out there, you still want to keep a really good personal relationship with those lenders because ultimately they're lending to you and they're trusting that you're going to be able to get their people's money back. And that's the most important thing to them, protecting the principal. All right. As I said here, it's good to have at least one of these that you're pre-approved through, but ultimately you should have multiple. But definitely, like after this webinar, if this is something you want to do, you need to find a hard money lender and go get pre-approved through them like right away. Okay. And some of them are going to require you to have an LLC. Some might not. It just depends. Again, something to talk to them about. I hear that a lot as mostly analysis paralysis people. So if you're one of the analysis paralysis people, you might be sitting there going, wow, this is all great, but I don't have my LLC and my website and my business cards yet. Just go take action. All right. If your hard money lender needs an LLC, go get it set up. It doesn't take very long, but in most cases you can do it without an LLC. All right. A conventional lender. So we got the hard money lender in bucket one, and then the conventional lender. This is again, like if you're going to go to Wells Fargo and try to get a home loan, this is typically the mortgage broker, the lender you're going to be talking to. And we are not usually going to use this person. In fact, we're never going to use this person for the purchase of the property. This is going to be somebody we're going to have in order to potentially refinance through once our rehab is done. Okay. So the conventional lender, here's some pros and cons to this. Typically, they're going to have the toughest underwriting guidelines. What does that mean? It means they're the hardest to get approved through. So they're going to be government backed. So they have this little tight box, and you got to fit all of your stuff into that little box. Otherwise, they won't lend to you. And again, I'm going to talk about some ways to get around that here in a couple slides. But just know that they're typically the toughest people to get approved through. So sometimes I'll hear from people that say, man, I can't get a loan because of this or that. And it's usually because they've tried to get a conventional approval and they've gotten denied for it because it is a pretty tight box. And depending on the economic environment, that those guidelines can tighten up and get much tougher. All right. Here's a pro. Usually it's the lowest rate and the best terms. This is why for refinancing, if you're looking to hold that property for the long term, these guys can be the best option for you because you can get the lowest interest rate and then it's fixed. It's locked in for 30 years. So even if interest rates balloon and they go crazy, you're locked in. They're not changing that interest rate. You locked it in at a very good number. All right. Negative here. Usually they're the longest lead time needed. So this is why, again, another reason why we never really use them for the purchase. If we're doing this burst strategy, it's because typically they need at least 45 days to close this. And again, if you're trying to solve somebody's problem and they need some cash out of this property relatively quickly, 45 days might be too long and you might miss out on that deal. Right. So having cash, so you'll see a lot of times people say, well, I got cash, I could buy your house quick. What they really have is a hard money lender set up that has cash that can close it quick. Okay. So just know that that could be a huge selling point for you to be able to get deals, to be able to buy deals at a bigger discount if you have that hard money lender set up. If you just have conventional lending set up, probably not going to be great for you. Okay. They're typically going to require 20% down on a single family home and 25% down on a 2 to 4 unit. Again, depending on your credit, your experience, those things, that it could be more than that. Like you may need to put 30% down in some cases on an investment property. I haven't heard of anything going more than 30% on an investment property through conventional, but just know that that might be the case for you. But typically it's a 20% down on a single family and 25% down. If you have a lender that's telling you otherwise, you might want to try to find a different conventional lender. All right. They're usually not going to lend above 4 units. That gets into it in a commercial. Once you go 5 units above, that goes into what they call commercial lending, which we're going to talk about next. So typically you're looking at refinancing with these guys on anything from 1 to 4 units, and they're an option. You don't have to refinance using conventional. All right. And we'll talk about the next, but they're great. I typically tell everybody get pre-approved through a conventional lender right away so that you know you can get your hard money lender back out of that deal quickly. Okay. Commercial lending, these are also known as portfolio lenders, typically like a community bank. You're typically not going to be dealing with the Wells Fargos of the world. This is typically a local community bank. There's a great website out there, icba.org, that you can go to, and I can share that with you guys later on if you specifically want that website. But you can go in there and just search your specific market or the market. If you're not investing locally, if you're investing out of your market, you can search that market and find some community banks in that area that will lend you. Otherwise, some people call them like a business banker, commercial lender. That's what we typically call them. Often, again, another big misconception out there is often you do not need an LLC to get a loan from these folks. So again, talk to the lender, ask if you need an LLC, but in a lot of cases, they don't care. They're lending on the property. They don't necessarily care if it's to you or to an LLC. Okay. But talk to them. Every lender is different. All right. These folks can be the most creative and typically offer the best structure for a loan. So they might not be the cheapest on interest rate and they might not lock you in for 30 years. But if you're looking to get some creative stuff going on with the deals that you're putting together, these folks can be the best. For example, and I'm going to show you guys an actual case study of this, of a property that we bought about a year ago. And the commercial lender we use lended up to 80% of that after repair value. So the example we shared with you guys earlier, imagine now if you could unlock another 15% and it was at a much lower rate than a hard money lender. I mean, it's game changing. So these guys can be great. So definitely want to start getting the word out there and building some relationships with those folks. They're heavy on relationships. So kind of like a hard money lender, like they're going to lend to you and they got to protect the bank and protect the principal and stuff like that. So if you can meet these people in person, I know right now at the time you guys are watching this, there's COVID going on and a lot of cases that might not be as feasible. Zoom's great. Like we're on a Zoom right now, Zoom with that lender, let them put a face to the name and get to meet you and all that sort of stuff. They're typically going to be looking for some kind of experience in real estate investing. So for those of you that are here and this is your first deal, it might not be right now that you get approved through a commercial lender, but that's okay. All right. But if you have a great W-2 and you got a lot of cash reserves and things like that, then they might lend to you, even if you have no experience. So we typically refer to them as common sense lenders. So once you have a little bit of a relationship and things like that, if you bring them a deal and it makes sense, they'll typically lend on it in most cases. Again, maybe different, in every economic market. So depending on when you're watching this webinar, that might be different in what kind of market you're in, but typically common sense lending. And it's good to have multiple options of commercial lending. Like for example, that same lender that funded that deal that we talked about was with a different bank about a year earlier, and that bank got bought out by a different bank. And if all we had was our eggs in that one bank's basket, we would have been halted on buying properties for a while. Luckily, we had a couple other options out there with commercial lenders, so we were able to keep doing deals. And then he went to a different bank and started up the same loan program, but it's great to have multiple options out there. And some lenders like real estate investing. So you might go to a commercial banker and they might be like, no, we're not really interested. Well, that's okay. Go to a different one because some other, they might be really heavy into manufacturing or some other type of industry. Some like the value add projects like we're talking about. Some like love that. They're like, this is great. This is exactly what we want to invest in. We want to invest in people who can fix up these properties and add value and yada, yada, yada. Others are like, no, we really just want to lend on properties that are already turnkey, as they call it, which means they're already fixed up and ready to go. So talk to them, figure out what they like. And you might need to have that turnkey thing for later on. Maybe you're going to refinance after you fix up a property with that turnkey commercial lender. All right. So here's a really important fact, guys. Last bullet point here. Even if a lender cannot pre-approve you right now, it's a great idea to start that relationship and ask for feedback on what you can do to get pre-approved. So you go through them, make the connection. Even if you're brand new, you got no credit, you got no experience, all that stuff. Build a relationship. Just say, hey, listen, I'm just starting out. I want to get more involved in real estate investing. I know that I'd be a great asset to work with you, a great partner to work with. What kinds of things are you looking for? And just start that relationship. And maybe you go through and you fill out whatever information they want you to fill out. And they say, hey, man, really right now, or hey, lady, right now we can't lend to you because of X, Y, Z. Okay, no problem. Like I'm going to work on those things and then just keep that relationship open, keep the dialogue open and stay in touch with them because they can unlock so much for you if you build those relationships and you have a good working relationship with them. Okay. So that's bucket number 3. Bucket number 4 is private lenders. So going back to earlier on how to find deals, we talked about how do you find deals. Friends, family are a great option. Social media is a great option, those things. This is another way. You might be out there looking for deals and somebody may say, hey man, I don't know anybody that's looking to sell a property, but I do have some cash sitting on the sideline. So if you find one and you need some funds for it, let me know and maybe we can work something out. It happens, guys, all the time. These folks, again, mostly relationship-based lenders, duh. They're going to know, like, and trust you, hopefully. Otherwise, why would they give you money? They might have smaller amounts available, so they might not be able to fund the entire deal, but they might be a key person to fund that rehab portion. Or like we said, there's some hard money lenders that want you to have 15% skin in the game. They might be that 15% to put into that deal. So they could be partial lender. They might be able to just cover parts of it, but they're great to have as an option. And there's plenty of them out there. A lot of people want the same things you do, but they just don't want to go find the deals. They want that stability of real estate. They don't want the volatility of the stock market. And that's something that you can provide them with on what you're doing. And that was actually how our first deal, that duplex I shared with you guys on December 30th, 2016 that we bought that got all of this started. That was a combination of me pulling out an IRA that I took some penalties on, and we used those. It wasn't much, but it was something. And then a family member had some money sitting in a mutual fund and didn't like the ups and downs of the market at the time. And I offered 12% interest if they would lend to me, and they loved it. And then they just kept wanting to keep reinvesting because it paid them back with interest. And then they were like, you got any more deals? Got any more deals? Got any more deals? So you may only need to find a couple of friends or family, and they might be able to keep recycling that same amount of money using this strategy. Just a little another disclaimer, guys. I don't know, depending on the laws and all that stuff. Again, I'm not an attorney. Check with an attorney. But when I got started, I was like, just like massive action. Let's go. And I'm putting stuff out on social media like, hey, I got some deals coming up. Like if you want to make a return on your money, hit me up. And I had to delete all that stuff because I got told, hey, you got to be careful. There's some SEC laws about raising capital. So you have to be very careful about how you do that. So again, just tell people you're in real estate and build your brand, let them know what you're doing, and the money will start to come in and people will start bringing that up to you. Or it's more of a personal conversation maybe you have with folks offline about, hey, if you want to be a partner in a deal, I'm looking for some silent partners, that type of thing. Okay. Just be careful how you advertise um, that. You really can't advertise how to raise money at the time of this webinar. That may change. Okay. And my last bucket, I love this bucket. When I do these in person or live and have a live audience, this is typically where I see some lights go on for people. I see them start to get some wide eyes and I start to see their heart race a little bit because maybe they were sitting through those other 4 buckets of money. And maybe this is you sitting at home watching this and you're sitting through those other 4 buckets of money and they seem unrealistic to you, or they seem like it's going to be too much work, or for whatever reason, you have some self doubt. This is when sometimes that can turn the light bulb on. So this is a HELOC, which stands for Home Equity Line of Credit, and that's what it is. It's like a low interest credit card. Think of it like that. So, um, how you get this money, that equity spread we talked about at the time of this recording, the markets in a lot of places have continued to go up over the last couple of years. So if you've owned your home for any time period, you probably have some equity in your house. All right. If you don't own a home, you're probably like, Corey, well, that's great for the people that own a home. But either I don't own a home or I just bought one like a year ago. The market hasn't appreciated that much. That's okay. Who do you know that owns a home? I guarantee you know somebody that owns a home. All right. And if they've owned that home for any time period, they probably have equity in that home. And how would they like to take out what's called a home equity line of credit or a HELOC? Let's say the bank's going to charge them 5% when they deploy the money. So meaning like a credit card, when they use it, they get charged 5%. And what if you could give them 12% and it still made sense? They're going to make 7% on the bank's money, on dead money, as we call it, that's just sitting in their property. And I call it dead money because let's say you got a house every month, you make that payment, goes into the house, but it's not like a piggy bank where then you can open it up and take that money back out unless you use this vehicle called a HELOC. It just sits in that safe, locked up. You can't get it. Okay. Why wouldn't you unlock that money and at least have access to it? Okay. So if you have equity in your house, this is something you should be doing tomorrow. All right. Go get that HELOC set up. If you don't own a home, or heck, even if you do own a home and you're going to set up your own HELOC, talk to other people who own their houses and see if they want to make a return on their dead money sitting in their house. And the cool part about HELOCs, typically banks don't charge closing costs or appraisal fees. Shop that around. If they do, keep shopping it to other banks. This might be one where you go to a Wells Fargo or some other banks. They might offer this product, and you only pay for it when you use it. They might have an annual fee, might be $50 a year or something like that. But otherwise, you're not using it. Where people get in trouble with these, the Dave Ramsey teaching of the world and those types of things, is when they go buy boats or depreciating things or things that, TVs or whatever with those things. If you just use it for the sole purpose, you're going to do just fine. All right. So those are the 5 buckets of money. And for those of you, as I said earlier, that are like, man, I don't have any credit, those types of things. What do I do if I can't get pre-approved? Well, you're going to have to get creative. Okay. Unfortunately for you, you're going to have to get creative. You're going to have some grit. You're going to have some determination. And what you're going to have to most likely do is partner up with somebody else. And this is where building out that network, getting on social media, talking to friends and family about getting involved in real estate is going to be crucial for somebody like yourself. If you don't have those, if you don't have a good W-2 job, maybe you're self-employed recently, your credit's in the tank, whatever the case may be, maybe you got to partner up with somebody who's got a solid W-2 and has good credit, right? And maybe you offer them like a part of the deal. Maybe you give them like an equity percentage or something like that for co-signing on a loan or those types of things. You want to keep building relationships over time too. So talked about that with the commercial lenders. If they won't lend you now, that's okay. Just keep building that relationship over time. And things are going to change for you. If you don't have the credit right now, you just start working on building that. And at some point in the future, you're going to have that credit. And then take the feedback that they give you, follow through on that. Whatever that lender asks you to do, go do it. And then keep in contact with them as you're improving those things that they've given you for feedback, and just let them know how you're doing and keep that relationship open and strong. And then keep building relationships with new lenders too. So keep the existing ones going, but then keep finding new lenders and start fresh with those folks. And I'm telling you guys, it's worth it. It is so worth it. If you're here tonight, there's something, like we said, lacking earlier that you want to improve on. Maybe it's that retirement, maybe it's that long-term wealth, whatever the case is. So going through all these steps, guys, using this strategy, it's worth the extra work, of course, in my opinion, or I wouldn't be here. I'm a little biased because I love this strategy and it's helped me a ton. but you got to have some grit if you're going to do the BRRRR strategy, especially if you can't get pre-approved through some of those lenders in the buckets of money we talked about. So let's put this all together now. So we've covered a lot of stuff on the BRRRR and the low and no money down strategy. Let's take all of that and let's compress it down. What do we really need to do? What does this boil down to? So number one, first thing you should do after this webinar, maybe if you're watching this tonight, you can do it tomorrow, but get pre-approved for some lending. So we got 5 buckets of money. Go start getting some pre-approvals going with some of those bankers and the HELOCs and those things. All right. Then once you got the pre-approval wheel in motion, then you need to find a deal. So we covered some options there of how to go out and source some deals. And then we're going to use anything other than conventional financing to buy and fund that rehab. Okay. So we can buy that property. We're not going to use conventional. We're going to use one of the other 4 buckets, and we're going to buy it and rehab it. Then we're going to rehab it. That's the other R. Then we're going to rent it out. Then we're going to refinance it. And we're going to repeat it. And then we get to do at the bottom right there, we get to throw some confetti and celebrate a little bit. All right. Because we're repeating this process. We're building some long-term wealth. So that's really the process, guys. That's what we need to do. Number one, get pre-approved for lending, get the deal, and then do the other R's. All right. So going back to this, hopefully this is making more sense now, guys. We're going to just bring this back full circle. So showing you guys the scenario earlier, you had 50 grand out of pocket going the old school way, doing it the BRRRR way. We've got 0 out of pocket using that hard money loan. All right. And our net worth just increased 70,000 bucks using that strategy. All right. So another thing, a couple things to consider. We talked about some of the myths or objections earlier, like who's going to do some of the work, who's going to do those things. Like here's some people that you're going to need on your team. So it's not just going to be you out there running this thing. You're going to need some insurance agents, right? So you're going to have to obviously insure these properties. You're going to need contractors to fix these things up. Property managers, I highly recommend property management. When I first started, guys, one of my mentors had told me, no, you manage it first. You learn the ropes, then you go get management. You know exactly like how to manage that manager. We now joke about it. And he's like, yeah, that was terrible advice. I'm sorry. And we laugh about it. He's like, you should have just got professional management day one. So some people out there, maybe you're already managing the properties and you're like, oh, I just turned Corey off. Like, nope, I don't agree with that. That's okay. All right. If you're already managing it and it works for you, that's fine. But for the vast majority of people watching this webinar, my recommendation is get professional property management day one. And that way you can just go add 70,000 bucks to your net worth. And that's what you're focused on, finding those good deals and building your team. You're not as focused on having to figure out a lease and deal with an eviction and my toilet's leaking and now I got to run over there. Like all the horror stories of those tired landlords that you heard, you're not going to have to deal with that stuff if you're using property managers. Now, I will also say not all property managers are equal. So make sure that you do your due diligence on those property managers and you pick the best ones because, you still have to manage the manager and you want to make sure you have some good managers or they can be a nightmare for you. And I can share some horror stories with you on property managers and offline, but I can also share with you guys how much good property management is worth. It's helped us tremendously by finding the right managers through trial and error, but got there. And a lot of times what I love about our property management companies we use, they have their own contractors and subcontractors. So I don't have to go try to find a contractor to fix these things up. They handle all of the construction and rehab for me. I don't have to do it. And most likely, I'm assuming here, I haven't done a case study with this yet, but I'm going to assume I save a lot of money on the rehab because otherwise I would probably spend way too much money doing things to the property that isn't really necessary for the potential location or the end goal of what we're trying to accomplish. And these professional property management companies, they're going to know like what types of finishes we need to do and all those types of things to get you the best return on your investment. All right. You're going to need an attorney or attorneys. Just have them in your wheelhouse. There's going to be some contractual stuff and things like that you're going to want to be able to run by these attorneys. And if you're in a state where you have an attorney closing the deals, then you're definitely going to need one. And then handyman, again, if you have a good property management company, you shouldn't need that, but it's always good to have some backup folks in case for whatever reason your property management companies ran out of guys or the guys are too busy or something like that to get to your property. And then we talked about realtors. They can be like your best asset if you find the right ones, and you don't need to just have one realtor. You can have multiple realtors out there working for you. And a lot of times a good realtor is going to know a lot of these folks above that can help connect you up with these guys, the right ones. Okay. So I told you guys earlier about that 80% ARV loan story. So here's the case study, guys. And this is an apartment building. So if you're brand new, this might be overwhelming to you. Like this might be too much numbers for you and too big of a thing. It might seem unrealistic. So just dial it down and like put it in whatever thing is going to make sense to you from a numbers perspective. But here's the deal, guys. This is 20 Forest Ave. This is the picture of the property here. It's a 39 unit mixed use apartment. So the bottom level is commercial. And then we have 34 residential units in this property. And we picked it up. We got a referral from our network, from our social network that we talked about. Purchase price of this thing was $730,000. The ARV, or the after repair value appraisal, came in at 1.356 million. We stuck about $100,000. That's kind of what we estimated or we budgeted for repairs, and we came in around there. Now we've stuck money in since then with some of the rents that we've gotten. We've put that back into the property, but at the time of the purchase, we stuck about $100,000 into this thing. So our loan that we got was $830,000. Now, this is what's cool. That bank that I talked about gave us that $830,000, and we had $0 that we had to bring. So we didn't have to go through the traditional, buy it with a hard money lender, refinance it thing. This bank, the commercial banks, is why I'm saying these guys can be huge for you. They just gave us all of that money right up front. So we had $0 into it. And then they gave us a loan after the rehab for about 1.049 million. So we were all into it for 830,000. 6 months later, we did all those rehabs. We got it all done. Actually, the property management company did it all. I just kind of directed them on what we wanted them to do. And the bank gave us a loan for 1.049 because that was just under 80% of that. We didn't take out the full 80, but that was a $219,000 tax-free cash out, basically, after the rehab. And why I say tax-free, it's a loan proceed, so you don't have to pay tax on that. If I ever sell it, different story. I'm going to have to pay gain on that amount that we have. But right now we got $219,000 from that deal, and we got to keep the asset, which is great. So we still have an asset. We have tenants paying down the debt. And 6 months later, we were able to pull that money out. So again, some of you guys, that might seem totally unrealistic of where you're at right now. You might be like, man, I just want to get my first deal. That's okay. This is why you'll graduate up to this. I started with a duplex, right? And you can do that too. It just starts from a small number of deals, right? Here's my brother, Andy Monty Raymond. I want to share his success, guys, of going through the program and obviously coaching him up on this process. Here's a deal that he bought. It was $93,000, paid $93,000 for it. That after repair value, it was an appraisal from the bank, came in at $130,000. Rehab was $6,000 on this thing. And again, I think this one he used commercial lending, that commercial lending bucket to purchase this one. His loan that he got from the bank at purchase was $104,000. So if you do the math, follow along with me here. Bought it for 93, stuck 6,000 into it. That was his rehab budget. Was all in for 99,000, and he got a loan for 104,000. So he actually got $5,000 back at closing. That's insane. So here's what he got out of this thing: $26,000 of equity added to his net worth balance sheet. And he got a $5,000 tax-free loan proceed at closing. Like, boom, done, right? So I know there's some people on here who flip. It's an option. Once you start getting some commercial lending set up, if you get the right lender set up, and depends again on the economic environment, but you might be able to basically like flip tax-free and keep the asset, right? By doing these different types of loans out there. So super cool on this one. And here's just a quick little blurb that he wrote up. I'm not going to read the entire thing to you, but I do want to just share a couple of the numbers here. So right here, it needed about 6,000. Talked about all that stuff, right? Property still cash flows after all of that with a property manager in place. He's still bringing home about $400 a month. So he's got an investment that costs me nothing, gave me $5,000 up front to use on other projects, and makes him an extra $4,800 a year. Plus he got that other $26,000 in equity. And again, that tenant's paying down the debt, historically appreciates. He's creating a big gap there. So again, he says it's pretty scary doing the first one, but it's very addicting. So really, really cool story there. Here's John Cody, one of my buddies here. We helped him get rolling with the Burr program, and that's his beautiful wife, Elizabeth. And this is the property he bought. It's a 3-unit property. And this was his first deal he did outside of an owner-occupied duplex. So him and his wife bought a duplex, live on one side, rented out the other side. So this was his first like true investment Burr deal. And here's a text I got from him after his refinance. I think I shot him a text above that top line there. And I said, hey, how did that refinance go? Do you have any money into the deal? And he said, I had to pay $35 because the lender wouldn't let him go to 70%, which I think he meant 75%, but that's okay. Otherwise, he would have got a check for $6,000 at closing of the refinance. So again, he's into it for a whole $35. I'm jokingly saying there. And check this out. He's got a loan for $94K. It's worth $142,000. So he's got $48,000 of net worth that he added to his net worth profit or personal financial statement. And it cash flows over $500 a month. So he's adding an extra $6,000 a year to his income for a whole $35 that he had to put into it. And then I love this. Asked him if I could share his success, and he wanted to, let people know at this time, hey, I'm only 24 and I own five doors now, which is pretty cool. So anybody can do this, guys. That's what I love about this strategy. Anybody can do it. Doesn't matter. Age is just a number, credit score, all that stuff. There's ways to do this if you have grit. So here's the thing, guys. This is super exciting.